Oil prices this year have sustained the high 80s or even till the hundreds, and it doesn't seem to be abating. The West Texas Intermediate, which is one of the crude benchmark oil prices, it's at $88 at the time of this recording, and Brent is at 96. The more important question is this: is this a sustainable price going forward for the final quarter of 2022 and even into 2023? In this video, we're going to see the potential price sustainability of this, as well as companies that might benefit from this sustained high oil prices. So stay till the end of the video to find out my thoughts. As a disclaimer, I do own some stocks mentioned in this video, and this video is by no means a buy or sell recommendation. If you do need licensed advice, please speak to a licensed fund manager. Before we begin looking at individual companies, I think it's good to understand the where the world production and consumption numbers actually are. Today, we consume roughly about 100 million barrels of oil per day. And the production is, the production curve, which is represented in blue on the screen, roughly kind of matches. Sometimes it or overshoots or undershoots the consumption. And I think this is a live figure because the pandemic has really brought a lot of changes to the volatility of the consumption curve, like China with a complete zero COVID policy in certain cities like Shanghai and Beijing has really reduced the consumption rate of oil. And so that's on the demand side. But on the supply side, what we're seeing is that even President Joe Biden has signed a release of a huge amounts of oil from the Strategic Petroleum Reserve. Now, this reserve, there's plenty of content out there, so I'm not going to go very deep into that, but I'll briefly explain it here. The Strategic Petroleum Reserve is an emergency reserve that is usually used or drawn upon when there's like a conflict or there's a war, because it helps stabilize national security. And most countries in the world, they do have some kind of a strategic reserve just in case there's a supply blockage or supply demand surge. And even Biden signing that off, and coupled with the OPEC announcing that they will actually reduce production by about 2 million of barrels of oil a day. So 2 million in 30 days time frame, right? You're talking about 60 million barrels of oil, which is it's quite crazy, right? And I think that's where the production and consumption balance really comes into play in determining the prices will remain at elevated levels or not. And how are we going to get actionable insights from all this? I mean, you hear headline news like OPEC cuts, Biden releasing Strategic Petroleum Reserve. It's not a guarantee that prices will go up purely because of this, but then at the same time, these are indicating measures to determine what's the supply balance equilibrium. And that's where you will see an elevated demand if, and I'm going to discuss this later, if we do not replenish the supplies fast enough. So riding on that last point, how do you know whether the global demand is being met by replenishment of supply? You straight away start to look at the upstream, which is where countries around the world, they actually award international or national oil companies with what we call leasing rounds. So what does leasing rounds actually do? In very plain English, it's like, I believe there's a patch of land or patch of sea that actually contains oil. And in order for that resources to be developed, they actually invite international companies to come and bid. And these international companies, companies like Exxon, ConocoPhillips, Shell, will come and bid, and they will put in money to develop the field in exchange that they can reap profits of the field for a certain concession period or a certain production sharing contract period, usually between 20, 25, or even 30 years. So that is the very start of how an oil field is actually developed. And how you want to monitor that number is actually looking at the lease rounds award per year. And if you can see in 2015, roughly about 54 rounds bidding concluded. It peaked at 2019 of 105, but in 2022, 2021, you're looking at below 60, 54, 58, 2022, even lower, 44. And these are signs that, oil fields or gas fields are not being awarded or developed fast enough to replenish the supply that we are facing today. I mean, oil fields are always on the decline. I know when you have peak production, and then once they hit their peak, it's just decline. And usually an oil field can last anywhere between 20, 30 years, sometimes even longer, but most of the time it will decline, right? Quite fast, quite rapidly, especially for shale oil. And this is right at the start. So if I were to draw an analogy like salmon fish, right? If you don't have the eggs and there's no breeding and there's no eggs, right? Virtually you're not going to get more salmon at the end of the season. And this is how the situation is for the oil and gas industry today. Another major factor affecting oil prices today is actually certain sanctions that Europe or even the US is imposing on Russian oil, which is one of the largest producers of oil and gas in the world today. And all of us know the Russian-Ukraine war brought no benefit to energy prices, no benefit to food security issues. And next month, Europe is expected to ban all oil imports from Russia and restrict Russian shippers from the global shipping industry. So here you go again. One of the largest oil and gas producers in the world, and their supply is being restricted to the market. So because of that, countries around the world, especially Europe, are forced to actually look for oil and gas from other countries like, maybe China, which has stockpiled their oil. And because of lockdown, they don't see that much oil demand, and that can be actually sold over to Europe. And US shale producers, that's where, in a way, I'm not going to argue who is right politically or not, but the US seems to be, having an advantage because the shale oil producers can actually now sell to European countries at much steeper prices because the European countries are restricted from supply for Russian gas and Russian oil. So one of the oil and gas production companies that is poised to benefit from higher crude oil prices is this Malaysian-listed company called Hibiscus Petroleum. This is an overview of their current portfolio of assets, listed in 2011, and they have assets in Malaysia, in the Malaysian-Vietnam joint fields, Australia, and United Kingdom. So I'm going to go through quickly some numbers that is very pertinent for you if you were to invest in any oil and gas exploration company. And these are some numbers that are so critical that before you even put money, you have to understand the meaning of it. So I'm going to go first at the PM3 field, which is the fields that they just recently acquired from Repsol. And the few numbers that you should look at is this thing called average gross oil and condensate production, or average net oil condensate production. Now, why are there two numbers? Think of Hibiscus sharing this field with a few other parties. Okay, for simplicity's sake, let's just say party A, B, and C, and A is actually Hibiscus. So the total field production is 14,000 barrels of oil equivalent, right? But Hibiscus take as a joint venture partner is actually 2,639. So those are the differences in the number. The next number you should look at is this thing called average production OPEX per barrel of oil equivalent. So what does this mean? It means this is the cost to produce 1 barrel of oil equivalent. So in this case, their cost is $11.34. If they can sell it here, this is number, average realized oil and gas condensate prices. So this is the amount. This is the price. That they sold it for $113, but their cost to produce it is $11. So the spread is what gives the profit to oil and gas exploration company, right? So that's the PM3 field. But there are other fields. I'm not going to go through all of them. Maybe this one. This is Kinabalu, okay, which is in Sabah. Average OPEX per barrel is 1061. And average realized oil price is 121. Now, these OPEX per barrel cost actually fluctuates quarter on quarter. And why these cost actually fluctuates, it depends on whether any maintenance work or any upgrading work happens within that quarter, because that maintenance cost is charged into that quarter's numbers. And when there's a maintenance activity, obviously you spend more money within that quarter, obviously your cost goes up. And that's why you see fluctuations quarter on quarter of this average OPEX per barrel. Most of the time, you don't increase headcount substantially. It doesn't change quarter on quarter. But what is the bigger factor is actually the maintenance cost that's being charged to that quarter. So on average, let's be pessimistic, right, in terms of costs. It's like 11 and 7 for the PM3 field, but let's try to look at the highest costs in their different assets, right? So this is North Sabah, okay? North Sabah, okay, look at it. So the average OPEX per barrel for the latest quarter is $27.95. Significantly higher than the earlier two fields. Now, they even clearly explained to you, and that this is something that I have to give my hats off to the IR team at Hibiscus. Very clear transparency, and even the tax issues, which I'll talk about later. They had a tax dispute issue with the Sabah state government, and they resolved it. So in this case, average OPEX per barrel higher was because there was a planned major maintenance campaign, and because of that, it was significantly higher. But if you look at the previous quarters where no major maintenance activities took place, it was between 12 to like $19 per barrel. So some other key highlights that Hibiscus actually shared in their deck is actually the number of oil and condensate or barrels of oil equivalent was actually very high for the past quarter. They actually realized a very high oil price based on the global demand today. And secondly, they settled their tax matters. It's been quite a material issue prior to this quarter, and I'm actually glad that they settled it. And they even had a net gain after netting off what they owed the Sabah state government and their rebate from the Inland Revenue Department. So, kudos to them. Net gain of 39.8 million. I found the third key message quite interesting as well. They actually appointed the executive vice president for exploration and production of Petronas, which is Emilia Dalan Rice Oxley. Very experienced executive in the oil and gas industry, and they got her as the new independent director effective of 5th October. So kudos to them. Another very high caliber person on their board, and hopefully it can help spur them on into greater heights, especially leading their charge in expanding their international portfolio. So those were the three. I mean, there's five, but I took away these three as the more important ones for me as an investor. So another company poised to benefit from the rising or sustained high oil prices is actually a company listed in Singapore called Rex International. Now, comparatively to Hibiscus, they did not disclose the production numbers of each individual field. However, they did disclose the ownership of the assets, their producing assets or the discovery assets. And most of it is concentrated in the North Sea and the Norwegian Sea. And I would have hoped that they would have been more transparent in their disclosure. Maybe it's a trade secret, maybe it's something that they want to not disclose in public so that their competitors won't know the production rate. I do believe they do release individual production rates on a separate basis, but as a table, I don't get it from their annual report. Now, a lot of times people lump all oil and gas players within the industry is all of them will benefit the moment oil and gas prices rise, which is actually incorrect. The guys that will benefit or have a direct correlation are oil and gas operators that can sell at an average higher oil price, and they earn the spread between the cost of them producing against the price that they sell. But if you're a service guy, someone like Yinsen, right, who leases FPSOs to operators, they are paid a fixed daily lease rate, and they do not get to enjoy an upside of increasing oil and gas prices, right? Other service guys like Schlumberger or Halliburton or the Dayangs of this world or the Petras of this world, they don't get to benefit directly, but they get to benefit indirectly because at elevated oil and gas prices, the operators will actually have more maintenance work, more new development, field development work, and that's where they benefit indirectly, not directly. So please know how to differentiate in between the service companies that benefit indirectly and the oil and gas operators that benefit directly from rising oil and gas prices. I hope you have gotten value in watching this video. Broaden your understanding of oil and gas operators and the different players in the industry, especially operators which I've talked about, which is Rex as well as Hibiscus, and also understanding that the replenishment of oil and gas fields has not really taken place over the past few years, and that actually is worrisome, because that's where, if demand outstrips supply and you're not replenishing your supply fast enough, that's where you see elevated oil and gas prices. There you go. I hope you've derived value, and if you did, subscribe, like this video, hit the notification bell if you want to know when the next videos are out, and do let me know in the comments if you agree or disagree with my thought process about elevated oil and gas prices, supply demand curve. And if you have any thoughts individually about these companies as well, I'll be looking forward to hearing your comments, and let's have a chat about it. So I'll see you in the next video, guys.